So today we'll be talking about interest rates and how you can lower your interest rate. I'd like to start off by saying I'm a licensed realtor here in Southeast Minnesota. I'm not a mortgage professional, so I can give you general information on how these concepts work, but you'll need to speak with your trusted lender to actually find out if you qualify. Now, at the beginning of this video, I'd like to maybe give a little bit of perspective on interest rates. I would say, as a millennial myself, a lot of young people and first-time home buyers, in the past few years, we have seen historically low interest rates. And in comparison, as they rise and now they're up to a little over 7%, it can seem really daunting and kind of scary because it does impact your buying power. I would just like to say, as young people and first-time home buyers, we don't have the most accurate, perspective or accurate framework of interest rates. In the 80s, specifically March of 1980, the highest that interest rates ever have been in the United States is 20%. So, the previous generations have seen those really high interest rates. So 7% to them, it's nothing, it's free money. But to a younger demographic who hasn't necessarily experienced that or wasn't paying attention at that time, it can seem like it's this dramatic high interest rate when realistically 7% is not terrible in the scheme of interest rates. So a little perspective there is always beneficial to keep in mind when you're looking. But that being said, I'm not discounting the fact that a jump from a 3% interest rate to over 7 can dramatically impact a lot of people's buying power. And that is why I'm making this video, to give you some ideas on how you can lower your interest rate. So the first way that you can lower your interest rate is probably one of the most well-known and probably more common sense options, and that is to refinance. So you could buy your house tomorrow at 7%, and you wait a year, a couple years, however long it takes for interest rates to start dipping lower, and you can speak with your mortgage professional and see if you qualify for refinancing, in which you can then get the current interest rate. The next way that you can get a lower interest rate is something called an assumable mortgage. So certain government funded loans like FHA loans, VA loans, as well as USDA loans can be assumed. And what that means is when you buy a home, you can take on the previous owner or the seller's mortgage. So you basically take on the remainder of their mortgage, and then you give them the difference in a down payment between the sales price and that loan amount. So ultimately, if that difference is a sizable amount of money and you can't afford to do that outright, you can get a second mortgage to cover that. Now, that second mortgage will definitely have to have that current interest rate of, if it was, today it'd be 7.1% or, whatever it is in your area. But the majority of your loan on the home will still be at that previous interest rate that the seller got it at. So it can really save you a lot of money over time. And one of the great things is, like, for a VA loan, for example, that's, Veterans Affairs or Veterans Assistance. You don't have to be a veteran to assume a VA loan. So, you have to qualify with your, credit score, things like that. That's what you'll talk to your lender about. But it's really nice because that's an option for you to get one of those loans that was back when interest rates were lower. Another way that you can get a lower interest rate is to lock in your interest rate early. So when you're searching for the home and you're in the process, now not every lender will do this, so it does depend on your area, your lender, things like that. But for example, my brokerage has a sister company that is Edina Realty Mortgage, and they have a program called Lock, Shop, and Home. Now basically, when you start the process and you're getting pre-approved, you lock in your interest rate at whatever it is at that time. Now you do have to pay a fee in order to hold it, but you can hold it for 3 months or for 6 months, and there's varying fees depending on which you choose. But you can lock in your interest rate at that lower amount, and when you shop for your home by doing showings and things like that, over the next few months or few weeks, whatever, how long it takes you, Then, as interest rates rise over that period of time, you've already locked in your interest rate. So you get 7% when maybe when you close on your house, it's 8%, but you'll still have 7%. So that's another way that you can get a lower interest rate. And then finally, there's also what's called an interest rate buy down. So some terminology to know for a buy down is mortgage points, discount points, buy down points. They're all the same thing, but generally a point is 1% of the loan amount. So an example of this is, if you are taking out a loan for $100,000 on a home, 1 point will be worth $1,000. So at closing, you would pay that point or, 2 points or what have you, and you'd be able to lower your interest rate. Now, like I said, 1 point or 1% of the loan price is worth 1 point. 1 point equals generally around 0.25% of your interest rate. Now, this does vary both based on your lender and your location, but as a general rule of thumb, you can expect around 1/4% for your interest rate. So that means if you have a $100,000 loan, your point is worth $1,000. So you pay $1,000, or if you did 2 points, $2,000, but you pay that $1,000 and you get to knock down your interest rate. If the interest rate was 7%, you'd knock it down to 6.75%. If you did 2 points, you knock it down to 6.5%. So far and so on. Now, a lot of lenders will have, a certain amount of points that they allow you, to go down. So you couldn't, make it down to 0 or something like that. But again, that's something to speak with your lender about. I hope this was helpful. If there are further questions, or if you want me to go more in detail about certain things, please like, subscribe, comment. I would love to answer any questions or give further clarification. Thank you.